Morning, everyone, and welcome to this webinar, Business Exit Planning and How to Avoid the Post-Sale Blues. This is hosted by PEM Corporate Finance with guest speakers from Hoare Co and PEM. So thank you for taking the time out from your schedule to join us today. So before we kick off with the presentations, just a couple of housekeeping points. The webinar will finish at 12 noon and we'll definitely keep to time. We'll be providing a recording of this session and I will circulate it around this afternoon. You'll notice there's a Q&A box in the toolbar, either at the top or the bottom of your screen. Please use that and type in questions during the session so I can then direct them to each of our presenters at the end. So our first presentation today will be from Philip Olagunju, who is looking at current conditions for M&A and the impact on valuation multiples paid. We'll be hearing from Kirsten Tassell from the PM Private Client team on getting your private also personal tax affairs in order before, during and post the sale of a business. That will be followed by Falconer, who is looking at building value in the business and some general points on exit strategy. And then to conclude, Ellie Newell from Hoare Co will be focusing on managing the proceeds of a sale and what to do effectively with your time post completion. So as I said before, we'll have a Q&A at the end of the session, so please use the Q&A box. Thank you to those who've sent me some questions ahead of this webinar. Philip, hand over to you.
Thanks, Shaun. Good morning, everyone. Hopefully you can see my slides and you can see me on screen. Perfect. My name is Philip Olagunju and I'm a partner here at PEM Corporate Finance. Today, I'll be covering off the current UK M&A market, valuations and the potential impact of COVID, and I'll also cover off funding for transactions. So when it comes to the UK M&A market, it's clear to see that the market was exceptionally buoyant in the first quarter of 2021. This was primarily down to pent-up demand following suppressed deal volumes in mid-2020, alongside fears over Rishi Sunak hiking capital gains tax and abolishing business asset disposal relief, which was formerly known as entrepreneurs relief. And we found that here at PM Corporate Finance, I think we completed 5 deals in 7 working days in the run-up to the budget on the 3rd of March, which was a bonkers time, really. And this combination created almost the perfect conditions for M&A activity. March 2021 was the busiest month on record, according to M&A data and analytics platform Mark to Market, which is where I get a lot of these stats from. A total of 635 deals were executed in March 2021 versus only 418 completions in March 2020. And looking at the last 5 quarters, what the chart on the screen shows here, you can see a significant decline in deals from Q1 2020 to Q2 2020, aligned with COVID-19 and lockdown and the protocols and all those things there. But a steady growth in deals kind of quarter on quarter, right through to 1,466 completions in Q1 of 2021. So what about deal sizes? We can also consider the dispersion of deals across different size bands. Nano deals on the left-hand side there, representing deals less than 2.5 million in value. Micro deals between 2.5 and 10 million, small deals between 10 million and 50 million, and mid deals between 50 and 250, as measured and described by Mark to Market. This chart shows a greater incidence as a proportion of total transactions of small cap deals in Q1 2021 relative to previous years, whilst there were fewer micro and nano cap deals. However, as deal multiples tend to increase with deal size, something called an EBITDA multiple arbitrage, we would ordinarily expect the higher representation of small cap deals relative to nano and micro deals. So what are these last two charts saying to us, right? It all points to lots of activity out there in the M&A market. But what about valuation? And particularly, what about the impact of COVID? Is it finger in the air time when it comes to valuations? Well, the simple and plain answer is no. It's about knowing the constituent parts that make up a valuation. Now, for context, there may be many different types of valuation methodologies that you'd want to think about and look at. You've got asset-based valuation, which focuses on the balance sheet. You've got discounted cash flows, which in my opinion is quite subjective. You've got dividend yield model. You've got Black-Scholes, if you want to be quite technical and academic. I'm going to be focusing today on the market method, which is pretty well known and has three main variable constituent components, right? You've got profit, and you've got profit multiple, and you multiply one by the other, and that gets you to enterprise value. And for clarity, enterprise value is all about the value of your business. And the third component are equity value adjustments to get you to the value of your shares. And these adjustments are typically looking at your debt levels, looking at surplus cash, and looking at your normalized working capital. So diving into the first of these component parts, profit, this chart shows the rate of EBITDA growth of FTSE 100, FTSE 250 and FTSE all share companies from March 2018 right the way through to May 2021. Now I'll pause there. EBITDA basically stands for earnings before interest, tax, depreciation and amortization, and is the measure of profitability closest to operational cash generation. M&A professionals like myself love talking about EBITDA. So rather than kind of baffle anyone with jargon, just think of EBITDA as a measure of operational cash generation, and we'll be on the same page. As you can see, the chart shows profit generation is down across the board from March 18 to May 2021. But understanding the context of this is really important. We had Brexit, then we had COVID-19, and these two kind of situations made for a pretty tricky operating environment. And one could argue that flat profitability across this period is actually a positive thing. Needless to say, it's really important to drill down into the specific details of a particular company's trading. The next component part are multiples. And this chart shows trading multiples and tracks multiples captured by a number of indices which attempt to measure private company acquisition pricing. EV/EBITDA multiples simply mean what number is multiplied by EBITDA, or your operational cash number, to get to enterprise value, i.e. the value of the business as a whole. The indices here are the BDO Private Company Private Index, which measures trends in EV/EBITDA relationship for quoted companies, and those evidenced by the sale of unquoted companies. So it's looking at what unquoted companies are sold for, and what the EV/EBITDA multiples for quoted companies are. We've also got the Argos Index, which measures the trends of Eurozone private market company valuations and trading multiples of FTSE 100, FTSE 250 and all share companies. And as you can see with the trend lines, multiples are pretty much held or increased, but it's really important to consider price and to consider value when we talk about these things. And the third of these types of charts I've got for you today, talking about debt. And the third component piece when it comes to valuation are adjustments to get you from enterprise value, i.e. the value of your business, to equity value, which is the value of your shares. And the component piece here is debt. And you can see from the chart here, which shows debt to EBITDA ratios of FTSE 100, FTSE 250 and FTSE all share companies. You can see that debt has increased generally over the period from March 18 to May 2021. And that increase in debt essentially has been to fund the shortfall in earnings over that period. when it comes to equity adjustments, it's really important to also analyze surplus cash. And in my mind, surplus cash is a cash not required for operational purposes. Hence, you can add that on to the value of your business. And also, you need to consider normal levels of working capital, as there's real money on the line here. However, this chart is really interesting for me. Despite the situation of falling earnings because of things like Brexit and COVID-19 and all those types of things, and increased debt to fund the shortfall in earnings, equity values have been steady, or they've been increasing over the period. This chart tracks the market value, i.e. share valuations of FTSE 100 and S&P 500 companies, and the values of these shares have been rising typically over the period. So it's fundamentally down to the value of the underlying business, underlying specific business, and their specific value drivers. Is it a niche company? How sticky is the income? How strong are the growth prospects? Are there any barriers to entry? Do you have any intellectual property in your business? Is that intellectual property difficult to imitate? So all of these value drivers are also key for consideration when it comes to the value of your shares. So here are some key valuation takeaways. And just a reminder that we're talking about the market method for valuation here. Please remember, number one, profit. Analyze your profitability in detail. Identify any exceptional costs or any one-off costs. Quantify the impact of COVID-19. Ring fence it. If you can quantify that in your accounts, that's great. In your management accounts is even greater. But focus on growth and focus on, I like this word, bounce back ability. If you're a business that has been negatively impacted by the things that I've spoken about already. Number two, multiples. Benchmark. It's quite funny to me the number of clients that we come across and we advise, and they think their business is worth 14 times because they watched a Bloomberg program or they heard it in the pub. Benchmark it. Multiples are an indication of market price, and so it's really important to know your market from an operational perspective. So know your market from a pricing perspective as well. And there are loads of resources out there that you can leverage for sure. And the third component point there, equity value, i.e. the value of your shares. Analyze the equity adjustments. So what's your normalized level of working capital? Do you have any surplus cash? And just think of surplus cash as, if I was to take this lump sum out of the business and take it off the balance sheet, would it detrimentally impact my company? If the answer is no, then that's surplus cash, right? What's your debt level in your business? Some people argue whether corporation tax should be a debt-like item or whether it's a working capital item. These are things that you should be thinking, right? Because it's all about maximizing price and taking as much cash off the table as possible if you're in a negotiation situation. And very quickly, final slide from me. Funding options. What are the funding options out there from an acquisition or buy side perspective? There are many, but I've summarized 4 key categories here. Now, the first one being high street banks. They'll offer asset-based lending, cash flow lending, growth capital, the full suite. And on a positive side of things, it's cheaper money, right? Slightly cheaper, but high street banks tend to be quite risk averse. And because there's quite a lot of bureaucracy internally, they tend to be quite slow moving, right? So, in terms of leverage multiples, so how much money can you get from these banks based on your EBITDA, your operational cash generation? Multiples tend to be between 1 to 2.5 times EBITDA, loan to value, sort of 60 to 80%, and you're looking at a 5 to 10% interest rate on those amounts of money. Next, we've got alternative lenders who offer debt and equity funding. They tend to be quick and tailored, but you'll pay for it. In my mind, I have a differential between high street banks and alternative lenders, a bit like buying a suit from Marks and Spencer's or buying a suit off Savile Row. If you pick up a suit from Marks and Spencer's, it will be cheaper, but it's an off the peg offering. Whereas if you go to Savile Row, it's tailored and bespoke to you, but you're going to pay more for it, right? A bit of a weird anecdote. Sorry, I'm a weirdo like that. So in terms of leverage multiples, you've got 1 to 4 times EBITDA, and because it's tailored and expensive, you're going to be paying sort of 8 to 12% interest rate. Third, we've got private equity that offer equity funding or debt funding in a leverage buyout scenario. They're growth partners, but there may be a delayed exit for you from a positive and negative perspective. Leverage multiples are between 1 to 5 times EBITDA, and interest rates are similar to the alternative guys, 8 to 12% with options as well. And finally, vendors can fund transactions via a vendor loan note. This tends to be cheaper and can push value upwards, but it takes time and carries risk. Again, 1 to 5 times EBITDA, but with a cheaper option of 0.5% to 2%. So that's me. Hopefully that gives you a nice flavour for what the UK M&A market is saying, and what the valuation kind of implications are in a COVID or post-COVID world, and a quick snapshot on finding options. I'll now hand over to my colleague Kirsten, who will talk about tax implications of an exit. Thank you.
Thank you, Phil. So just wanted to look at some of the main areas to consider with regards to the personal tax implications of a sale. 3 main areas: preparing for the sale, reporting the transaction, and the fun part, enjoying the proceeds. So firstly, preparing for sale. The key point here is that you really should start your planning early as possible. Main thing about the planning is to ensure that you're going to qualify for all the reliefs that you can and that you're expecting to qualify. Now, the main relief, as Phil mentioned earlier, is business asset disposal relief, previously called entrepreneurs relief. Now, whilst the lifetime limit has reduced from 10 million to 1 million, so it's not quite as valuable as it was before, it is still valuable because the 1 million of gain will then be taxed at 10% instead of 20%, so quite a significant saving. To ensure that you qualify for business asset disposal relief, your conditions that you have to meet have to be satisfied throughout a 2-year period before the transaction. And because of that, this is why you need to ensure that everything is met early on, because if you find, you're about to do the deal and you suddenly discover that actually one of those conditions you don't meet, you're too late. You either have to delay the sale so that you can meet the conditions for 2 years, or you have to go ahead with the sale and not get the relief. So that's why it's important to prepare early. Because the limit has been reduced significantly from 10 million to 1 million. Apologies, my slides have got stuck. You might want to consider utilising the allowances of other family members. For example, your spouse. He or she may already be an employee or a director in the business, and but doesn't have any shares or doesn't have the sufficient 5% shareholding. So again, you might want to consider whether it will be sensible to make a gift to your spouse so that that person can also qualify for the 1 million lifetime allowance. So as a married couple, you effectively can double your lifetime allowance and the amount of gain that can be taxed at 10%. But again, the conditions do have to be met throughout the 2-year period. So that gift of shares does need to take place more than 2 years before the transaction. Another thing to consider is whether actually long-term you're thinking of maybe setting up a trust for children or grandchildren. An ideal time to consider that is when you still have the shares in the company. At that point, the shares will hopefully should qualify for business property relief. And that means that you could put the shares into a trust without crystallising a lifetime inheritance tax charge. If you were to put cash into a trust during lifetime, the value of the cash over and above the nil rate band of £325,000 would be taxed at 20%. That's a tax charge immediately that has to be paid over to HMRC. So, however, if the asset you're putting in qualifies for business property relief, i.e. shares in an unquoted trading company, then provided certain anti-avoidance rules do not apply, those shares can go into the trust free of inheritance tax, irrespective of the value of the share. So you're not restricted to the nil rate band. So that needs to take place before there is a binding contract for sale, because at that stage, the revenue will treat it as your gift in cash. So that's something to consider. If you're thinking a trust will be useful for your family planning at some point, then putting the shares in rather than the cash will save you a 20% inheritance tax charge. Now, the gift of the shares will obviously be a capital gains tax disposal, and there are circumstances where that gain can be held over and deferred so that there is no tax to be paid at that point. The tax will be paid when the trustees sell the shares on the transaction. That holdover relief does not apply if you or your spouse or your minor children are beneficiaries of the trust. But any other beneficiaries like adult children, etc., if they are the beneficiaries, then you could arrange to get the gain held over. One thing to bear in mind is that once you've made that transfer into trust, that is complete, that has happened, that gift is completed. So if the transaction doesn't go ahead, you do need to bear in mind that those shares are then in the trust and you have effectively given them away. Okay, the second step, important point from a personal tax perspective, is how to report the transaction. Firstly, if you're not already completing tax returns, you will need to register for self-assessment. And you need to notify the HMRC that you have a liability to tax, that you're chargeable to tax by the 5th of October, following the tax year in which you made the disposal. The key thing with most transactions is there is usually an element of deferred consideration in what you're getting. So there's some form of earn-out. Now, the way that that is treated for tax purposes varies depending on how that earn-out or deferred consideration is structured. So it's really important that you take advice at the time that you're dealing with the transaction so that you understand the implications for you and also how much tax you're going to end up having to pay. One thing to bear in mind, in most circumstances, this earn-out or deferred consideration will be taxable upfront to some extent. So you will be paying tax on something you haven't yet received. So from a cash flow perspective, it's important that you understand that and that it's not a nasty shock when the 31st of January tax payment date comes. So other thing to consider is how much of the transaction to disclose to the HMRC. Now, disclosure is very important. It protects you. As most people know, the revenue have 12 months from when you file a tax return to inquire into it and ask questions. However, if you haven't made sufficient disclosure on your return, then they have a much longer period in which they can make a discovery assessment and come back and seek additional tax. So it is important that you disclose sufficient to give you that protection. So it's important that you speak with your advisor to protect yourself on that. The last bullet point on this is, can we help with other shareholders? There may be employees who are exercising options maybe, and therefore realising that they're also selling their shares on the transaction. They may never have done tax returns. We can help advise them on how to complete their tax returns, what information needs to be disclosed, etc. And now we could come out sometimes and talk to a group of your employees if that is relevant. Okay, now the third step, this is obviously enjoying the proceeds. Now, the whole process of selling your business is stressful. There's no doubt about it. But once the transaction is over, that's also quite a stressful time in a different way, because suddenly you've spent all your life, or a lot of your working life, building this business 7 days a week. This has been your life, and suddenly that's all over. What do you do on a day-to-day basis now? How do you fill your time? How are you going to invest the proceeds? Now, Ellie will be coming on to that in a bit more detail, but from a tax perspective, you need to think about, will you be retiring, so no longer working, or are you going to reinvest into a new business, whether that's setting up one yourself again, so you need to take advice, or whether you're going to be an angel investor and invest in other people's businesses and take on a slightly different role. The other key thing from a tax perspective is that you have now sold your shares in your business that probably would have qualified for business property relief. You now have cash. Cash is not an asset that's going to qualify for business property relief, and therefore your inheritance tax bill potentially is going to increase significantly. So it may be a time to step back and have a think about the bigger picture and to see what planning is relevant to you, or what you need to do now or maybe in the future. Things to consider obviously are gifts to family members, and some people think about setting up a family investment company, which is just a company that the family has shares in and you can jointly invest together. But a lot of people like that as a way of bringing in the next generation of their family members to start understanding the concepts of investing and how to manage the money without giving them total control. Finally, from me, is charitable giving. At this stage, a lot of people think that now's the time that they would like to make a significant donation or set up a charitable trust or use the Charities Aid Foundation. I think from a tax perspective, the key thing to think about is the timing of when you make those donations. If you're going to make a large donation, you need to make it in a year, or in a year where you're able to get tax relief for the full amount. And it may be that you need to make the donations in a different tranches of money to ensure that you can get as much relief as possible. So do seek advice at that point. And Ellie will be talking more about charitable giving. Okay, and I'd like to hand over now to Lake.
Thanks, Kirsten, and good morning, everyone. My name is Lake Falconer. I'm a corporate finance partner at PEM, and this morning I'm going to talk to you about three themes: making your strategy work for you, how to make your business more attractive to an investor, and then a quick whirlwind tour of exit options. So first off, thinking about exit strategy and making it work for you. And I'll come to why the maps in a minute. The world is pretty complex out there. There's lots of moving parts. And I think the key is to resist the temptation to come up with a strategy that's over complex to respond to it. Strategic planning theory, as I understand it, says you create value, you capture it, you sustain it. And there are broadly three logics of value creation. And on screen is the first one. That's the strategy of the map room, if you like. The idea of capturing value through position. So you stake out a position and build barriers around it. If you're a tech company, you have protected IP. In the military context, you capture the high ground and fortify it. And then there's the strategy of the storeroom. Now that's the idea of capturing value through resources. You control them. So resources that are rare, that are valuable, that are hard to imitate. So maybe a business like Gucci with its brands and designs. And the military analogy would be to have better military hardware than the next guy. And then thirdly, there's the strategy of the battlefield. And that's the idea, that's of capturing value through opportunity. You identify a gap in the market, you pursue unmet demand for profit, particularly appropriate in growth and volatile markets. And I suggest that's pretty much what it feels like out there and has done for the last 2 or 3 years. So that's probably pretty relevant. Now, I'm sure that one or more of these will resonate with you in terms of how you think of your own business strategy. And in my experience, most business owners have a pretty good idea of how they should drive their business strategically. The real challenge is how you actually get it to happen. And there's been plenty of studies which show that 60–70% of business strategies either disappoint or frankly just don't happen. So here's just a few basic tips on how you might make it happen based on numerous exit strategy discussions and follow-ups that we've had with businesses. And the first one is get an external facilitator you trust to work with you and your team to draw forth your strategy. Get off-site or wherever you go to avoid distractions to do that. Make sure your list of strategic objectives is a short one. If it's not a short one, fingers of one hand, then they're probably not strategic. And focus on the execution, the follow-up. Make sure that all the tasks and actions have got someone's name against them and a date and a reporting follow-up. Strategic planning theory is linear. You plan something, you execute it, and you defend it. I think in the current climate, we need to take a leaf from the military's book. Military strategy, I understand, is very much more about iterative loops. So you try something, you come back, you test it again. So I think that works. And then bear in mind the responsibility point. Peter Drucker, the business guru, put it pretty well. He said that no decision has been made until carrying it out becomes someone's work assignment and responsibility, and that until then, it's only good intention. So my take home would be, make sure your strategic plans don't languish at the level of good intentions. So having got your strategy working, how do you make yourself look more attractive to a buyer? Well, I'm going to talk now about how businesses look from the standpoint of a buyer. Now, on the screen, I've got there an extract from a strategic exit planning review we did with a real business a few years ago. That's slightly anonymized. And this was a business which was involved. It had a technology and also services division. And the top of the page is a sort of current state, future state analysis. So on the left, this is where we are now with key facets of the business. On the right, this is where we need to get to. And the actions in the gap should interlock with the key actions from your strategy. In this case, it was mostly to address the imbalance between the lower margin services business and an IP-driven products business. And then below the radar charts, what these are illustrating is some key points that drive value. And this is based on research in the States, based on real SME sales. So, and in those charts, 5 is good, 1 is weak. So on the left, at that point now, when we did the review, this was a business with great customer satisfaction and growth potential, but at that point it was weak in terms of dependence on the owners and defensibility of some of what they were doing. By the end of it, as if by magic, they built the second tier management team, improved profitability, and built some more recurring revenue. So the shape looks much better. It's an interesting way to visualize it. In this particular case, it went on to be sold successfully. The products division was sold to a tech buyer, and the services was sold to an MBO team. And so it shows how you can really use this kind of planning to get your thinking to work for you. I think the other thing that's useful, and it picks up some of the same points, but there's definitely an overlap, is to think how your business would look through the eyes of a buyer. And we do help people to buy businesses as well. So we've got some insight into this. And this is my 10 themes that I think buyers will be thinking when they look at you. They'll look at your financial performance. Is it sustainable? Is it risky? What about the scale of your business? Do you have growth potential? Is the business scalable? Will it have synergies with my business if I buy it? What about your customer base? Is it attractive? Absence of dependencies. I'd be worried that there was a dependency on you as the owner, on suppliers or customers. Positive cash flow cycle. Well, I need to put more money into the business once I've bought it. Customer analysis. I'd be really interested to know, is there concentration, obviously, but how unique is your offering? Just how loyal are your customers? How satisfied are they? Recurring revenue, of course, is the holy grail. Consistent revenue generation is great for a buyer. Intellectual property. I want to know what's the intrinsic value of your business. What am I getting besides the fixed assets? Key employees. I'm going to be really keen to retain them. So I want to understand how I achieve that continuity and how I get the relationships handed over. What are the relationships like in the company? Your sector. Are you in a growth market? Are you exposed to, for example, imports? What's M&A activity like in your sector? And then finally, if it's critical to the revenues, I want to know your brand, your culture, how I preserve that, and so forth. So this section hopefully gives you an idea of how a buyer might look at your business and how you can build value towards an exit. So now for a brief look at the kind of key exit options. Liquidation, top of the list. Well, that's generally bad news, isn't it? But sometimes it's actually the technical option if you sold the trade separately and you need to wind up the company to get the cash out. Then there's employee deals. These typically address succession, reward, retention, as well as exit. And the two key themes there are employee ownership trusts and management buyouts. They do similar things, but they have different tax consequences and different structuring opportunities around them. Useful to do a compare and contrast. Then there's mergers or negotiated sales. In reality, people talk about mergers, but that's usually a sop to the target. There are very few. Mostly one guy buys the next guy. And that would be a negotiated sale, which is the sort of thing pops up if somebody knocks on your door and makes you an offer. Obviously, you don't have a competitive process there, but you can get a good deal. We very often get involved in supporting companies to land the fish when that's happened, providing negotiation support. The next two are quite similar. The sale to a trade buyer or to a private equity house. Often this would be engineered via a confidential auction, and this will give you the best price, probably. And then finally, there's an IPO. Obviously, flotation is complex, but it can give you the best price. And I think the best reason for flotation, of course, is if you're planning to go on an acquisition spree, because it's really useful to have quoted paper with which to fund the deals. So I've mentioned exit planning reviews, and they can be a great way to bring all of this thinking together. And the approach needs to vary depending on your time frame to exit. So an exit planning review would be something you'd think about 2 to 10 years out. And the aim would be to have a plan outlined and some key actions and expectations set. So you'd probably cover personal drivers of the business owner, M&A activity in your industry, what's your trading history and prospects, what are the value drivers, the key intrinsic features of your business that will drive your multiple, sort of stuff that Phil talked about. How does the business look like from a buyer's standpoint? The things I've just been mentioning. Valuation and price expectations, again, picking up on Phil's content. What different exit choices do you have, and an assessment of how practical or desirable they are? And obviously tax planning, some of the issues that Kirsten was talking about. And then a perception of exit readiness and timing. And by the end of it, you should have your key strategic actions lined up with timings and responsibilities, picking up my point earlier, so you can make it happen. If you're thinking about an exit readiness scan, you're probably 18 months or so from exit, close enough to the anticipated exit to have that visibility of the market and the business cycle, but far enough out to address the potential weaknesses in your business story and to establish a meaningful performance track record. And there are 5 key questions for this kind of review. Firstly, is your proposed timing still right? What's happening in your company's market? Are valuations in the sector attractive? And how are they trending? Is the original anticipated exit route still practical and preferred? Number 3, what other performance improvements might you use to allow you to capture more value? Number 4, have you got a pipeline of value creation initiatives that could extend after the sale to the next owners? Is there gold in the ground for the next guy? And number 5, have you got your plans for your proceeds sorted out? Have you thought about what you'll do with your life after the deal? You do need to start thinking about that. And that's a great segue into Ellie, who's going to talk about that amongst other things. Thank you.
Thanks, Lake. So good morning, everyone, and thank you for your time. My name's Ellie Newell, and I'm head of the East Anglia office for Hoare Co. I'm joined today by my colleague Hayley Lake, a relationship manager in the team, and we'll both be available to answer any questions you have at the end of the presentation. I'm just going to spend 5-10 minutes giving you a brief overview of the bank, and then moving on to some tips on managing your money and time after exit. So for those of you who may not have heard of us, Hoare Co is the oldest bank in the UK and one of the oldest banks in the world at almost 350 years old. We were founded by Richard Hoare in 1672 and are still owned and run by his descendants and 11th generation partners of the bank. The partners today run the bank in an unlimited liability company, which, as I'm sure you're all aware, is highly unusual for any company, let alone a bank. It really dictates how we run the bank, which definitely remains conservative and makes for a very safe place for customers to place their money. We look after the needs of high net worth individuals and provide all the typical high street products you'd expect, but with genuinely great customer service. You'll be pleased to know there's no automated telephony service or chatbots here. Because we're small, with only 400 staff, we can genuinely make really quick, practical decisions, and we don't have to go through many layers of credit to get things done. And after 347 years of operating out of just 2 sites in London and having been in our head office since 1690, we took the rather radical, well, radical for the bank, decision to open a regional office in 2019. And where better to do this than in the booming entrepreneurial city of Cambridge. We've been welcomed with open arms by the community and had a fantastic couple of years growing our customer base locally. So as part of this presentation, I promised to give you some tips which may help along the journey to and beyond exit. And as my PM colleagues have already alluded to, preparation is absolutely key. Many of the customers we look after often seek private banking service ahead of exit. And this can be because they have non-standard requirements and they're finding things difficult with their high street banks. Most potential customers typically fall into one of these categories. Lots tend to pay themselves small salaries as they have continued to reinvest in their own businesses. Many have lumpy cash flows, and plenty have their wealth tied up in structures with loan notes or shareholdings in AIM companies. And these structures don't typically sit well with the mainstream lenders. People are often met with a sort of computer says no response. This is when a private bank like us is really able to help and come into their own. Every lending request is unique from every customer, and we treat it that way. To bring this to life, I thought it would be helpful to outline just a couple of examples of how we've helped some customers. So one customer wanted to buy a second home, but they couldn't find a mortgage lender who would recognise his income streams. He drew a minimal salary from his business and took income by way of director's loan repayments, which obviously don't appear on tax returns, hence the challenges for most mainstream lenders. So we assessed the business on a standalone basis, got comfortable with his ability to sustain the level of required repayments, and ultimately enabled us to lend him £3.5 million to fund the purchase of his second home. Another example was a customer needed to raise 1.1 million to avoid having his shareholding diluted in a fundraise. We managed to provide the full amount secured by a second charge over his home, which some lenders can be a bit funny about, and also over a shareholding in his company, which was listed on AIM. Moving on to practical tips for dealing with the proceeds of a sale. So if we fast forward to the imminent sale of your business, and a lot of people have been so focused on getting the deal done, as Kirsten said, it's a very stressful process, but most people genuinely haven't thought about the practical decisions of what to do next. Most people won't have ever had the kind of sums of money that they are about to get into their bank account, and are genuinely nervous about whether that's safe, particularly as the government only guarantees a maximum of £85,000 compensation per bank. Now, you could use this rather lovely looking lockbox, which is in the bank in our Fleet Street office, and I do think it probably do quite a good job. It looks quite secure, but in more practical terms, it's probably far more sensible to guarantee the security of your money with a safe organisation such as Hoare Co. Because, as I mentioned, the partners have a personal unlimited liability, means we've got a really strong, stable and liquid balance sheet, which gives our customers peace of mind so they don't need to worry about their money. While lots of customers may have future plans for those proceeds to put to better use, they're not going to get great interest rates, but many find it reassuring just to have a home for it, at least in the initial stages, before deciding on their next big steps. At that stage, of course, we can help with relevant introductions to wealth management firms or other culturally aligned advisors. And when the deal is done and the money is safe, what next? As Kirsten said, a lot of our customers wouldn't know what to do with themselves after years of building up their business 7 days a week, 365 days a year, and suddenly they're just found twiddling their thumbs and they don't quite know what to do. Of course, everyone's different. Some may genuinely enjoy the quiet life, but what we most often see is that people are sort of looking for their next project. Just as an example of one of our customers, she'd sold her business and really didn't know what she wanted to do next. She was quite clear she didn't want to start another venture, but she was interested in sharing her knowledge and experience with other founders. We happen to be aware of another customer in the same sector, but at an earlier stage of the journey. We were able to connect the two. The customer became a non-exec of that business, which has continued to thrive and be successful following her involvement. We also organise lots of dinners with interesting entrepreneurs, both in our Fleet Street office in London and also in Cambridge. And we find this a really, really fantastic and relaxed environment for like-minded individuals, just to get to know each other and share their experiences. And finally, something that lots of people do really like to focus on after exit is philanthropy, whether that's through volunteering, through events, mentoring, or even setting up their own charity. And this is a topic really close to our hearts at Hoare's, and dates back to 1719 when Henry Hoare founded Westminster Hospital. Today, 10% of our profits go to charity every year, and more than 50% of our staff have voluntarily signed up for the Charitable Aid Foundation account, which the bank actually double matches for every payment made in. One of the solutions that we do offer to our customers, which is quite unusual for a business in the UK or a bank in the UK, is a donor advised fund called the Masters Charitable Trust. This in effect provides an umbrella vehicle for people to set up a charitable entity, but without the administrative time and cost of setting up their own charity through the Charities Commission. I'm told that can take upwards of 18 months and be quite a painful process. I mean, there's definitely a time and a place to set up a charity, but sometimes people just want a really efficient way of giving charitably. Our customers tend to like the Masters Charitable Trust as it provides a really tax efficient method of giving and can often be used to help educate the next generation on this important topic. So that's it from me. Just want to say thank you very much for your time today. I hope that you found all the presentations useful. We'd be delighted to open the floor to answer any questions you might have, and I will hand back to Shaun.
Thanks, Ellie, and thanks to all our presenters today. As I said, we'll circulate that recording round after the session. If you do have any questions, please use the Q&A module in the toolbar. But I do have some questions actually to fire away to our presenters now in the last 10 minutes. Philip, if I start with you first, this is a question concerning a particular type of business. So I own a construction business that generates profits of about £300,000. What sort of multiple should I expect?
It's put me on the spot. So I'd need to drill down into this particular individual's company to understand what type of construction that their company was engaged in. I guess looking at recent experience, we've been engaged in a couple of construction related businesses recently. We sold a firm of architects, ATP Architects and Building Surveyors, to RSK Group a couple of years ago, and the multiple paid for that business that was generating about 500-600k worth of EBITDA was 4 times. And then we sold another construction-related business around about the same time, English architectural glazing. We sold to private equity, sold to Ellie Newell Partners, and that was 4.5 times, and that was a business that generated historically up to 4 million EBITDA. So quite a wide range in terms of profitability, but EBITDA multiples in and around 4 to 4.5 times. I guess another component piece to consider before I hand back to Shaun is, I think I touched upon it in my talk earlier on, EBITDA multiple arbitrage, which is effectively larger companies get bought for larger multiples. It's all down to risk. I mean, the smaller the company is, the more likely the individual who runs that company performs a myriad of roles. We tend to see smaller companies having the MD as the finance director, as the commercial director, is the person who locks up and opens up a first thing and last thing in a day. And so when you've got such concentration of decision making, if anything was to happen to that individual, that business would probably cease trading. So we tend to find buyers wanting to pay smaller multiples, because the multiple is effectively a reflection of how long it will take the buyer to get their money back. So a 5 times multiple reflects 5 years to get their money back, because each kind of year is kind of multiple of profit. Whereas larger companies have the infrastructure and decision-making capacity disseminated effectively internally, such that if one key individual were to walk away, well, that individual is probably likely to be replaced easy. And I'm just using that as an example to kind of reflect the different risk profiles of smaller and larger companies. So no, a construction business, I'd need to understand what type of construction, but 300K, probably 3 to 4 times. But then if there are kind of value drivers, niche construction, a strong second tier management, so there's autonomy within a key decision making capacity, then you're probably looking to push north of that. Over to you, Shaun.
Thanks, Phil. And kind of sort of following on about, say, thinking about an exit, Lake. So let's say that the kind of the business owner has done an exit strategy review. What can that business owner be doing between that review and actual exit to actually help make that kind of work, make that strategy work, actually implement it?
Yeah, that's the ultimate challenge, isn't it? I guess some things will just drop out of the planning that you've done. There'll be some specific actions. A really common one, and Phil touched on it there, is the need to build a second tier of management. So sometimes that's a hiring, sometimes that's coaching people who are in the business. And then, of course, there may be specific business things that need to be done. I think the other key thing is probably just how you plan it. Be prepared to bring people in. So, coaching of people, for example. The other thing we've found really useful is actually just to keep picking up the conversation again, keep testing the water. It's very easy to get focused on the day-to-day business, but this stuff needs you to get your head up and look to the far distance. So what we'll often do if we've done an exit planning review is to say, well, what would be a sensible frequency to come back, maybe get off-site or just have a meeting and just revisit it. Are we on track? What's changed? Because sure as fate, something will have changed. Nobody ever gets to their desired destination by the route they thought they would. So it's about being agile. So I guess very long-winded way of saying that if you get the planning right, there should be some obvious things that you crack on and do. But the other thing then is to keep testing it. It's what with Brexit and everything, we were probably in such uncertainty that you needed to keep having iterative loops of strategy. And then when you overlay the whole pandemic business on it, I think that's definitely the way. Keep going back in maybe every 6 to 9 months and say, are we on track? Mm-hmm. And also do the valuation stuff that Phil talked about. There's no harm in once a year actually saying, what do we think we were? We've got some companies we work with who do that. They do the calculation every year and say, well, we've gone up and down. So there's a lot you can do without distracting. But I think the key thing is to somehow carve out some of your time from the day-to-day to actually work on the business in this way with a view to exit.
Mm-hmm. Kirsten, one for you is once the decision's been made advisors have been appointed and a sale was going to happen, be it a sale to management or a sale to a trade buyer or an equity buyer, at what point on that kind of timeline should that business owner be speaking to their accountant about their personal affairs? Should they leave it to kind of later in the process, or have those discussions early?
Definitely have them early. The discussions, the earlier they are, the better. One, to ensure that you do qualify for the reliefs, as I said in the talk, because I have seen situations where you have got to the date where we get pulled in at the last minute, and then they're about to sign the deal, and actually we have to discover that they didn't qualify. So I had a situation where somebody didn't qualify for entrepreneurs relief when there was a 10 million limit, and they were expecting to have to only pay 10%. So getting us in early so that we can ensure all of that, but also just in the negotiations, looking at how the way that they structure the deal and the way they structure the consideration can have a massive impact on how somebody is taxed. As I said in my talk, a lot of the situation where you have deferred consideration can be structured in different ways. And you can get to the situation where it's been structured in such a way that you end up paying more tax than the cash you've received on the deal. Mm-hmm. So we can help prevent that by just explaining how the various different options are going to be taxed on the shareholders. So really, you can't get us in early enough, really, because that we will be able to help make sure that the transaction is smoother for you as a shareholder. Mm-hmm. Less nasty surprises.
Yeah. And and then following on from that, Ellie, is I've kind of realised that the value of the business, I've got to become into quite a lot of wealth. So what makes a bank such as Hoare Co a safe place for deposits when the government's only guaranteeing up to 85,000?
Yeah, I mean, we're no different from any other banks. We the guarantee is £85,000, and I think a lot of people find themselves in situations where they've opened 10 or 20 bank accounts to deposit all the money, and obviously realistically that's a lot of work and not a practical solution. All I'd say is that people can see our balance sheet, our financials directly on our website. You can see how strong a balance sheet we've got. We've been around 350 years, so hopefully our history speaks for itself. But we currently have deposits of 6 billion. In fact, it was 5 billion this time last year. So it kind of shows how much that's grown in just a year, because people see us as a safe place to put the money. And we're only lending 1.8 million. So we would never lend more than 50 pence in the pound. About 2 billion of those deposits are sat with the Bank of England overnight. And we also don't operate in the wholesale banking market. So that's very different to other organisations. If you look at any of the big banks, the high streets, their balance sheet, it takes a very qualified accountant to probably understand the intricacies. So yeah, I think we're kind of safe, secure, and our unlimited liability sort of backs that up.
Mm. And then quickly, this will be the final question. Hayley, how would what say would like your three kind of headline benefits of using a private bank rather than using a high street bank, which you may have used for a number of years?
It's a really good point. I think the first thing that would spring to my mind is communication. So what we've certainly seen over the past 12 months during the pandemic has just been, I guess, the value, and it can't be misunderstood in terms of how important it is to be able to just speak to your banker. And I think that's what we do very well at Hoare Co, in terms of, you've got that point of contact and you'll always be able to speak to somebody. And I guess my second point, just touching on what Ellie mentioned about being 350 years old, is that we have seen a lot of crises over that time. So I think that gives a lot of comfort to our customers that actually we can deal with situations like this, and that communication and just the reassurance is really, really important. So I personally, I think that the communication is is the biggest aspect that we can offer to our customers. And like I said, that can't be kind of undervalued, I don't think.
Excellent, thank you. And that brings us nicely actually onto 12 noon. So I can bring this webinar to a close. Thanks for everyone for obviously presenting today. Thank you to as well for attending. As I said, I'll circulate recording and contact details for each of our presenters after this session. So thanks again and have a nice day. Bye-bye.
Bye.